Should U.S. investors be worried about Chinese data? This has been a developing story over the course of the last several months. You can see here Chinese inflation, and you could look at a number of Chinese data points, whether it's trade balance or the part of trade balance that's been so much a part of the Chinese economy over the course of the last decade, which is their exports. They're a huge exporter of goods, and that's run a huge positive value at their trade balance, has diminished to some recent historical lows. But inflation, it's coming, the next inflation print coming from China in the next couple of days here. And it's one of the starker stories when you compare it to the U.S. and other regions globally. And so we're going to stick with this as being a major data point, but you can really take a look at, like I say, trade balance or GDP, all trending in the same direction out of China, and that's to say lower. And we'll get to the ties to the U.S. in just a second, because you might be saying, well, what the heck? Last time I heard U.S. inflation is too high, and now you're going to tell me Chinese inflation is too low? In this global economy we live in, how could they be contrasting so starkly? We will explain it all. But first, let's lead with what's coming out of China and how it's been affecting their stock market, and then tie in the U.S. piece in a second. Because, yeah, Chinese inflation printed negative for the first time in years last month, and they're set to announce their inflation this month. It'll fall on a Friday night, which will be kind of funky, but will likely make waves or not if it comes in line. But if it prints to the downside again, could make some waves in stock markets that coming week. And you see here some of the waves that it has made over the course of the last several months. Trending lower is the inflationary measures, the trade balance measures, the GDP measures from China, as well as their stock market. If you haven't looked at the performance of Chinese large cap stocks, which are represented here by the ETF FXI, compared to U.S. stocks, man, you've been missing a really interesting story that's been developing. Because here in the U.S., especially if you're looking at the NASDAQ, if that's your primary measure of U.S. stocks, that's a market that's up 40% compared to a market here in 2023 that's off between 5 and 10% and has printed negative every year for the last 3 years. 2021, you see the negative return. 22, the negative return. You see the bounce back at the end of 22, start of this year. Globally, people thinking that, okay, we've moved past the pandemic, we've moved past the inflation story, and now things are hunky-dory again. Not so much in China, is, yeah, they're set to have a third year in a row here of negative returns in their stock market. And you can't help but relate that to these economic data points that we've been seeing out of China. And we'll compare them to the U.S. in just a second, show that how they're different, and show why there's been maybe a disparity in stock performance, and also try to see if we're heading the same way as well. Because, yeah, the story has been, is this economic slowdown siloed off? And now you're looking at that inflation measures, same one that we started the show with, but the last 10 years. And you'll notice that it was doing pretty well, hugging 2% for the majority of the last decade. And then right as the pandemic is hitting, you see a high inflationary period. And then the pandemic brings it down to the only deflation that China has seen in the last 10 years. And that, of course, only occurred for a couple of months there. And now we're right back. And there's, of course, the pandemic awful still, lingering in a few different ways. But the silver lining economically was that you could blame deflation or this economic slowdown on this pandemic. And then as central banks globally did what they could to prop up their economies, you saw the fight back. You saw the markets come back in line and actually end up positive on that 2020 year in the case of the U.S. market and a few others, and then do well throughout 21 and everything else. And now China is back into this deflationary mode. Their economy is slowing down so significantly, and there's not much to blame aside from just pretty organic as it can get, I guess, economic slowness. They're companies that are operating in China are not exporting as much as they used to. They're still importing at the same rate that they have been used to, and the Chinese government seems dead set on trying to build their economy back up internally, but also by shutting off its borders to an extent, which can shut out a lot of innovation that Chinese companies could potentially take on. And so a really kind of intense and interesting problem is occurring for the Chinese central bankers and government officials who now, like I say, don't have anything globally to necessarily blame. They don't have a financial crisis or anything like that to blame. They just have a market that is printing in deflationary modes and a GDP that's not growing as much as they had liked. And a growing fence, I guess, for lack of a better term, around their borders and what they're willing to allow to come in terms of innovation that could maybe help their stocks and companies and economy prosper, and a pretty deep hole to dig themselves out of here. Whereas you go to the U.S. and you see a relatively similar trend, which is during the pandemic, inflation dips, GDP, everything dipped, employment, all these things dipped for a few months there, rebounded well to get back to normal, which is in this measure that we're looking at, inflation here today, is around 2%, and then skyrockets to too much economic activity, too much money changing hands for goods and services. And similar to China, rebound and then have been coming off the last several months, but still well above the 2% target, still kind of in that, you don't want too much inflation, but you want some so that you can see that your economy is moving in the right direction as opposed to the deflation we're seeing in China. And so the question becomes, the Fed right now worried about inflation rather than deflation and still thinking about raising rates. And again, going back to how siloed off from China, and now it's become Australia is getting hit with some of this and some neighboring regions and economies there. How siloed off is the U.S.? Because if we raise rates to close to 6%, which is where the market right now at 5.5%, and looking like they could raise rates once or twice more, the Fed could. If that economic slowdown does start to come into the U.S. here and rates are so high and they've gone potentially too high and inflation now goes falling through the floor of 2%, and GDP falls and all these different things, will we be in the same camp as China? Now, all of that in mind, the market is one of the most efficient measures of the past, present, and future that we have out there. And this is to say that the S&P 500 or the NASDAQ, which is up, more than twice the S&P 500 is here on the year, they're aware of all of these facts, right? Our markets here in the U.S. price in Chinese inflation and trade balance and all of these different numbers, the same as Chinese stock markets do. And with that being said, at least, for the time being, the S&P and the NASDAQ has been able to shrug off these poor Chinese economic data points. Now, that being said, it feels like, especially in the last week or so, U.S. stocks have been monitoring the situation, so to speak, closer than ever. And then, of course, you have the developing stories around Chinese government officials no longer being able to use Apple products and maybe some other U.S. company products. And we'll see how far that goes. But like I say, you can't really argue with the fact that S&P is still up more than 15% on the year, in the same time that Chinese stocks are, obviously feeling the weight of these economic data points being in the wrong direction. FXI down almost 10% on the year. But that could turn around very quickly. And yeah, the last inflationary measure from China that did print negative, like I say, for the first time in the last couple of years, FXI moved lower on that day by about 2%. That was August 8th. And the NASDAQ and S&P also moved lower by close to 1% on that day. Since then, they've been able to shrug that off a little bit. The U.S. stocks have, but yeah, we'll see, one, what the inflationary number and the future Chinese data is to come over the course of the next month. Two, we'll see if U.S. data points, because U.S. inflation comes right after that, if we're still siloed in our own world here. And then three, we'll see if U.S. stocks continue to trend in their own direction, or if at some point see a little bit of the effect of these Chinese data points.